This is a deal that is not on the radar.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. With exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Morand, and I will be your host for this week's episode. And I'm very, very excited to be here. We'll be joined very shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets and expose what's really going on in the whole industry, in the precious metals industry. So get ready for another blockbuster episode of Live from the Vault, and we'll bring you the knowledge, the understanding that mainstream media just won't provide. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, after coming so close to triggering the very heavy central bank buy orders that you drew our attention to last episode, we received a lot of Live from the Vault community questions, whether the cartel can keep capping the gold from rising as we start picking up the thread. Maybe we can start by right there in terms of what is happening from our last episode 2 weeks ago.
Yeah, Shane, great to be with you. Great to be with everybody. And of course, you know, so yes, we'll very much so we get the short term out the way, but also we're going to look at why the cartel's days are numbered and much, 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 much more. Now, the bulk of subscriber questions, which is kind of where we start, have related to the very steeply rising dollar. And given on the other side of that foreign exchange currency cross, you know, this trade, it usually means gold gets sold off. So after all the long, you know, really all the long dollar, what it means is if you're long the dollar, you're short gold, it's a foreign exchange. It's like long dollar, long short euro, and et cetera, et cetera. People forget that gold and silver are not just commodities. They are currencies. So let's address that short-term situation first. And just to provide a little context of what we're seeing right now, let's start by benchmarking gold against the steeply rising dollar. And we'll look at why Stockholm syndromed gold market pundits need to rub the scales from their eyes to know and understand the truth. The global south is knocking on the back door, chaps, and gold is calling out the dollar-denominated price. Now, following an extremely volatile 3 weeks of September, can't believe it. I mean, here we are already coming up for the fourth week. Let's look at the short-term chart chatter, which is what a lot of the questions have revolved around. But also, let's look at the notable takeaways as we head into the end of this third quarter at the end of this month, and set up for the fourth quarter, where a consensus of first and second tier liquidity providers are actually anticipating a physically driven contraction of this massive short paper to long physical divide. Simply put, borrowed and sold gold has to be repaid. In fact, current paper market gold leverage has reached the sort of extremes not seen since the 2008 financial crisis, but it's actually layered even more bullishly and slightly structurally differently as we enter 2024 trading. Now, if we just use the house-rigged 95% win ratio, which is like any good casino, these borrowed COMEX-centric gold futures positions, they rely on these undeliverable bets against gold being able to be squared against the speculators inside the casino before these bets against gold spill out of the back door into the net stable funding ratio compliant physical delivery global markets. Now that's kind of like the encapsulating it. But currently, this expansion of paper market leverage, meaning how many chips are put into play that have a willing taker, this leverage has been keying off the automated fiat-backed, inversely correlated dollar gold cash settled algos. We've talked about them before. It's straightforward. It's simple. They're just algorithms that automate every rise in the dollar, sell gold, etc. Now, they mindlessly sell gold. They've been mindlessly selling gold against a 10-week dollar rally, but have run into an unfactored drain of physical gold, which the paper market relies on to leverage these Fed, COMEX, LBMA-centric borrowed gold short sales. And of course, what we're really highlighting is the officially driven Fed-centric gold market interventions. And why so aggressive? Because the Fed feels threatened that a rise in the use of monetized physical gold is undermining the hegemonic dollar-based sanctions that they imposed. And we did, as we discussed in our last episode in a lot more detail, in the larger picture, physical gold is increasingly being employed as the perfect barter currency for the sanctioned Russian energy trade. And in fact, this barter trade seems to have slipped right off the radar until just 4 weeks ago. In fact, we drew attention to this last time. This trade has actually not ever ceased to function, all the way back to when Russia officially pegged a gold gram price to its oil trade back in March 2022, when this incursion originally and the sanction originally hit them. And of course, the reason they did that was because it circumvented sanctions, and it became the target of an official gold market intervention, which has not ceased since. However, this trade has just become far more sophisticated, and at the margin is now severely undermining the resulting Western paper price as it runs into a higher, physically deliverable Global South determined supply-demand price. This is severely disrupting this siloed, leveraged, ring-fenced Western gold market structure. It's not a real structure. Leverage works in two ways. And at the margin, again, this unfactored exit of physical out of the LBMA CME ring fence, it presents the short sellers, people who've sold gold they don't have, relying on squaring these fiat-backed foreign exchange bets inside the casino. And they rely on that. And this is a big problem. Oh, goodness, look, I can't wait to expand on this in a minute. But before I do, to answer your questions, let's wrap up the short-term stuff now and then really get into it. Now, this might not interest non-traders, so I'll keep it to a minimum, but I promise I will get to the cartel's demise. And it is important because we do have to look after everyone here. There are people who really do require to know what the price is doing on a shorter term basis and the actual structure. So bear with. So first, really stepping back to look at the gold and silver short to medium term perspective as related to an overbought, Fed-driven dollar index rally. Over the last 2 weeks, the dollar index has hard tested its 6-month March the 10th high. So that was the last time we hit the 105s in the dollar index. Now, the dollar index has risen steadily from around 99.58 on the 14th of July to 105, I think it was 105.43, I think it was, before topping out last Thursday, basically. Now, when benchmarking the dollar index 105 level to gold and silver, under the daily chart chatter that we see, the volatility, it's quite evident that physically driven safe haven gold and silver demand is steadily eating into this 100% paper-centric inverse dollar to gold and silver algo. Now, to put things into perspective, look at the levels where gold and silver were trading the last time the dollar index tagged the 105 March 10th highs. On that day, the dollar gold had just commenced a large rally with gold trading from $1,830. And so last week's over $90 higher low that was created at gold futures, that was 1922 or thereabouts. So from a gold perspective, that is actually trading at $9,000 higher per COMEX contract than when the dollar index traded it last at 105. Now, that's pretty painful if you've bet against gold since March. And this illustrates how this long dollar, short gold foreign exchange trade is bullishly losing traction.
That's amazing, Andrew. And how does this work for silver then?
Yes, I figured that might be the next question, Shane. Of course, it's actually even more, I say even more potentially a bullish setup. So when benchmarking this $105 index back to March, silver was at $19.90. That's pretty much the lows it made then. Now, last week's low was $22.71, and that is $2.81 per ounce higher. That's $14,000 per contract higher than in March when the dollar index was at 105. So think about that for a pain if you're on the wrong side of that. So this beggars the question, really, why are the dollar index and the silver gold benchmarks higher? Well, really, we need to cover the two main reasons for it because, as you know, as longtime subscribers know, something major happened on the 1st of January. Spot gold became an NSFR-compliant, deliverable, fully backed first-tier asset class that really began to compete with US Treasuries. And gold, for the first time in over 50 years, began attracting both paper and physical gold, safe haven demand. Now, as far as the paper gold markets are concerned, there is evidence that an increasing group of the COMEX commodity trading advisors, this group, have recognized that Basel III compliant gold morphed into this first year competing asset class, and they're actually employing at least some paper gold as a risk hedge, meaning their cash settled COMEX open interest longs, yes, the same casino chips, and because they're being used as a financial tool, they've actually become sticky and far less able to be rinsed by the cartel. So really what we're saying is, so net of what can be cash settled against the muscle memory specs who have no skin other than a paper position, have no use for gold and silver other than a bet, the paper price has risen actually in relationship to this inverse fiat settled dollar index precious metals crosses that we talk about. And secondly, there's two real main reasons. The very recent March 2023 failures, if we remember, not just long ago, it triggered the first round of bank bailouts since 2008. And that exposed the Fed's weak flank after raising rates so fast. It exposed these banks to really unfactored duration risk. With the Fed dropping the ball before being rescued, of course, the dollar index sold off and safe havens were sought. Now, fresh banking contagion concerns were perceived to be just under the glossed over surface. So there's a couple of good reasons why gold is starting to erode into this rise into the dollar. We've seen the dollar rise with gold in the past. Not since 2008, really, but it has happened. Now, the Fed relies on a rising stock market as the cover to raise rates. And this is when we evidence the Fed aggressively intervening in all of the crosses, not just gold and silver, especially gold, but not just gold and silver, making sure that they wanted to keep that stock market just at that right. They'll torque it to just the right level. They don't want to see a crashing stock market. It makes it virtually impossible to raise rates. However, with the Fed boxed in and deposit outflows from the banks racing into money market funds, these tail risks prompted a round of Moody's second-tier bank downgrades, if you remember, as well as Fitch, let's not forget it, threatening the first-tier too-big-to-fail bank downgrades. Now, first-tier bank downgrades do not get implemented or discussed lightly. It pushes back against the all-is-well Fed narrative, but it illustrates that the Fed is traversing a knife edge as it tries to walk the inflation talk while really gaping into the financial hellhole that they've created. Now, even a 25 basis point September hike could be sufficient to risk this forewarned first-tier too-big-to-fail Lehman moment bank downgrades, which would undoubtedly force the Fed to backtrack and cut rates. Now, obviously, we're actually recording this episode just ahead of FOMC tonight. So when you'll be viewing this episode, the Fed's plate spinning efforts will already be in the rearview mirror. So at least you can look and look at how this all relates. Now, this is why we are once again evidencing really the thin end of a large safe haven move out of risk, or at least a move to hedge risk. Now, footprints indicate a paper and physical gold demand setup that really closely mirrors a large move into safe havens that really followed the 2008 banking crisis, which initially evidenced a race into safe haven dollars, and that caused an initial gold crash or downside dislocation. But then, as the dust settled, evidenced a race out of cash into gold and silver. Who the hell was going to trust cash in a bank? And as we discussed in our last episode, the last time we evidenced anywhere close to this scale of dollar to gold market disconnect was 2008. And again, this was a period when gold rose alongside the dollar index as both actually began to compete with each other as safe havens. Well, if you're going to race in anyway, obviously being the cleanest shirt of a dirty laundry, you need to get into something. Well, gold is perceived as a safe haven, but clearly gold has a 5,000-year history of that. The dollar very much less. Now, following massive bank failures, though, this was in 2008. And there was downgrades. Both paper and physical gold were then, right after that, chased into a 3-year, $1,200 safe haven rally with really almost no pullbacks along the way. And joined at the hip, silver also rallied alongside the dollar index, rising well over $40 as investors exited bank investments, also converted their bank withdrawals into safe haven silver as well as gold. So really, to sum up, the Fed is now playing with fire. Today, we are already seeing bond yields at 2007 highs. And if they insist on walking the rate hike talk, we likely see bond yields spike higher again, which will almost certainly trigger the warned pre-Jackson Hole Fitch and Moody's first tier, too big to fail bank downgrades, that opening up the potential for a current dollar and gold safe haven rally to unfold. Only this time, gold is now a first-tier asset class.
Yeah, that's amazing, Andrew. Information you just can't get anywhere else, right here on Live from the Vault. Now, Andrew, just before we started recording, and you mentioned it again just a little earlier, that you were illustrating how you call it muscle memory has fooled a lot of gold analysts to accept the cartel prices, the suppression that we're seeing, that it's never, ever going to stop. And you were talking about how this becomes a self-fulfilling area here that keeps many potential gold investors just on the sideline. Can you expand on this dynamic that you're seeing?
Yeah, Shane, and as promised, look onto the deconstructing the gold analyst Stockholm syndrome, and that's the best way of really looking at it, because it boggles the mind. Now, what many pundits fail to grasp is that while accepting that the siloed COMEX futures market's tails wags the global physical dog, loads of people say, yeah, that's the case. It's nothing you do about it. But it confuses so many as to why market making CME issuers and stoppers, and well, that's simply buying and selling, delivering and buying gold within the casino, how they shuffle billions of dollars of paper gold warrants amongst themselves every day. It's just the term who's delivering or buying casino gold. But almost no COMEX vaulted physical gold loadouts, meaning what leaves the back door, ever result. Meaning, while billions of dollars of gold is recorded as delivered and sold every day, that is, no one removes this gold out of the casino's ecosystem. And that can include being squared up inside this illusionary exchange-traded fund of the GLD that we've done episodes on this before. And we've done videos about this, why you can't trust it. And even though it seems counterintuitive on the face of it, the lack of physical gold withdrawals from the exchange is misread by many analysts that gold must be correctly priced for the Western markets, and that the equilibrium, daily, weekly, monthly, and annual supply-demand balances, they must have ultimately be satisfied. Well, 50 years or more of deliberately house-instilled muscle memory, as you put it, rightly, what it does, it absolutely relies on it ensuring there is enough paper market liquidity to cash settle paper gold deliveries, thereby preserving this fractional amount of heavily leveraged paper gold from ever exiting the siloed COMEX to enter the unleveraged, physically settled global marketplace. Now, while continued cash debasement really has forced a very slow, higher stair-step gold price to evolve from about $250 to $2,000 over the last 23 years, this carefully managed multi-year paper market gold price suppression retreat relies on the officials' ability to continue to manage this illusionary balance by ensuring the US traders continue to be locked out of accessing the 10 times larger NSFR compliant, physically settled global foreign exchange markets. Hence, the gold market pundits accept the disparity between the price of COMEX gold and the impossible to ignore significantly higher premiums being discovered in physically backed global exchanges that are largely inaccessible to them. And because they're inaccessible, they're discounted. And however, while the CME LBMA alliance has colluded to manage this directly related Western market controlled global the gold fixes, and what they do is that we talked about this before, they contain the local London fixing process to just a few cartel members, and they just clear a fraction of what's really bought and sold globally every day, but it fixes the price, and it relates directly to the COMEX pricing mechanism. The emergence of competing Sino-Russian physical exchanges benchmarking an average plus or minus $50, in some instances to well over $100 an ounce, premiums over the cartels generated so-called global gold price. And it threatens the alliance's ultimate demise. Yet while the Chinese gold markets are actually largely inaccessible to global traders, so are dismissed as a threat, the increasing liquid physically settled gold-backed Moscow spot and futures market exchanges, which out of necessity sprang out of weaponizing the US dollar, are accessible to friendly countries and will be the undoing of the Western gold market cartel in very short order. Now, this is because no matter which jurisdiction physical gold is priced in, every ounce, kilo, ton bought and sold has to find an equilibrium price for that jurisdiction. But given that the bullion has to be sourced out of just one single global supply of readily available physical gold, those offering bullion for sale, what are they going to do? They're naturally going to seek to sell their bullion to the higher price jurisdiction, clearly. And as global commodity markets begin to be priced in non-dollar currencies, gold will increasingly be priced in the currencies that can be accessed, that can access these higher priced jurisdictions. However, as was spun by the mainstream media after the so-called BRICS currency non-event, they called it, this glide path to alternately priced commodities has been grossly underestimated. Now, leverage is the cartel's Achilles heel, and it is at this margin where the cartel will lose the ability to plug this growing paper to physical chasm, and a true global gold price will emerge much sooner than most analysts expect and completely off the radar of the mainstream media. Now, the last time a notable physical gold imbalance was called out was in 2013. A lot of traders will remember this, after the cracks appeared outside the price-setting COMEX in the 10 times larger foreign exchange gold delivery markets. Now, this paper-to-physical gold imbalance was exposed on the 1st of April, actually by one of our clients, who was giving us a letter, but it was exposed on the 1st of April 2013, when the first-tier LBMA bullion bank, ABN AMRO, wrote to all of their gold clients, refusing them physical delivery of their gold, forcing cash settlement of their gold holdings. Think about that for a minute. This caused a race by spooked gold investors and institutions to demand physical delivery, threatening to implode the cartel's multi-trillion-dollar rehypothecated gold market. And even if we accept the published 2010 Reserve Bank of India's official estimate of 92 ounces of paper gold traded for every physical ounce held by these market-making too-big-to-fail banks, not even accounting for the much larger unreported derivatives, that is, Houston, this was a major problem. And the failure to deliver by a first-tier, too-big-to-fail bullion bank triggered an immediate rushed meeting of the Presidential Working Group, followed directly the very next day by the largest coordinated paper market intervention since the Brown's bottom, about $250, some 13 years before. So really, in summary, gold was immediately hammered over $500 lower from the 1600s all the way down to about $1,045. And to ensure the paper gold pricing conduit was corralled safely back inside the COMEX, US traders were locked inside the casino and its back door was slammed shut. And this was affected by suddenly banning US traders from accessing the 10 times larger spot and foreign exchange markets, siloing their activities inside this paper market casino again. However, fast forward to now, and despite every failed effort to block foreign exchange gold from being recategorized as a first-tier asset class at the start of 2023 trading, if we remember, we evidenced the Bank of International Settlements squaring all of their swaps and leases and just getting them down for over 500 tons to zero at the Fed's expense. We did an episode about this. It forced the global liquidity providers to back up their foreign exchange gold bets with physical gold bullion. So net of how many short gold positions officials can now offset against the speculators corralled inside this casino, it now severely limits the downside traction within a defined but rapidly rising stair-step range. Now, since the 1st of January, official interventions have become very limited, and current dollar pricing for gold is viewed as a multi-jurisdictional central bank buying opportunity for the global south.
Hey, Andrew, we had a lot of feedback on your exposing how the gold barter trade has picked up. Is this still the case?
Yeah, this is definitely the case, Shane. While the significantly higher China gold price is not easily able to be arbitraged, as we've highlighted, the Moscow price is increasingly being arbitraged. And this is affected by way of a willingness for Russia to offer us to swap a $40 odd plus or minus $40 higher price for gold bullion in a direct barter for the energy trade. Now, obviously, this unfactored physical demand, because if you're a friendly country and you are and you need to buy oil or gas and even grain in some instances, then obviously, what's your best way of doing it? Go buy physical at the COMEX price, take delivery of it, and then exchange it for a hell of a lot better priced energy. So now we've highlighted how these purchases are bought in small enough volumes so as not to incur large premiums. Now, then this bullion is then de-dollarized by way of exchanging, bartering it for oil, gas, grain. While this trade is very attractive for energy traders on a limited basis, this gold for commodity trade will very soon be formalized into Glazier's gold-backed 20 commodity bricks plus currency. Now, this trade has become far more sophisticated and again, at the margin, is now severely undermining the Western paper gold price as it is arbitraged against an increasingly liquid, higher, physically deliverable, global south determined supply-demand price. I cannot stress enough how when leverage unwinds at the margin, the unfactored exit of physical from this LBMA CME ring fence presents the short sellers relying on squaring these positions, these short bets against gold inside the casino. It presents them an increasingly larger problem. The Fed's bets against gold are coming into the crosshairs. Now, notably, As we mentioned last time, this drain on physical gold stepped up in earnest after the BRICS summit moved over to Moscow just 3 weeks ago, unreported, of course. This was also on the radar of last week's East Economic Forum, the EEF Vladivostok attended by leaders and government representatives from the Asia-Pacific countries, the global south, aligning themselves to build out a pivot from the West to Asia. None of this gets reported, really. Non-dollar payment systems were front and center of these meetings. And much as Glasiev's BRICS currency basket is under discussion, it is the gold-backed 20 commodity currency option that would plug the gap and ultimately enable a more formalized currency basket to ultimately be established. A more realistic, truer, global, physically determined supply-demand price is just unavoidable. And given gold will ultimately at least partly back some of 80% of a multi-trillion-dollar energy market, an as yet unknown higher gold price is going to emerge. And while the BIS and all the central banks except the Fed are long physical gold, there will be little resistance to a Western gold price revaluation elsewhere. And the Fed is going to have very little choice but to also tap into its gold revaluation accounts to avert global central banks en masse demanding repatriation of their exceedingly underpriced US domiciled gold holdings. This is a deal that is not on the radar.
So, Andrew, you mentioned China's gold market premiums. What are you seeing here?
Yeah, China, and this kind of gets onto the Stockholm syndrome we encounter on a day-to-day basis. Looking at China's gold market versus the COMEX. Now, we consistently evidence the equally but inversely siloed Chinese markets, commanding a plus minus 50, that's averaging $50 an ounce over and above the COMEX derived price. And last week extending, I think, to $120 an ounce. And it is the apparent lack of the ability to arbitrage this difference that fools pundits into believing that the Western gold price suppression will continue ad infinitum. It's just not accessible. Now, it's important to understand that once on one side of the pricing equation, we have the official protection of US dollar hegemony, where the dollar is benchmarked against highly diluted, rehypothecated cash-settled gold. But on the other side, equally siloed, a PBOC that is openly and surreptitiously alchemizing this Western paper gold into a physical gold as it builds its reserves ahead of sanctions, which, like it or not, this is going to happen. I'm almost certain it has to, following an inevitable invasion or repatriation of Taiwan early next year. Now, look, this has got to happen before Trump gets into power. And as we've also recently drawn attention to, China is openly preparing its citizens for war. We've talked about the speeches that are being made in prior episodes. We've named all the people who have done it. And as part of this preparation, the PBOC has openly incentivized its citizens to buy gold. So the process began in 2010 when the wealthy were incentivized to buy gold, big billboards, buy gold, bullion. And this year, it expanded to the wider public. And this involved placing a guaranteed support price under the Chinese gold price. And this is why there will always be a premium in China and the Chinese gold at really the equivalent, if you want an equivalent to the gold price. It was fixed at about $2,000 gold futures when it was earlier benchmarked this year. So really, if we want to sum this up, the COMEX is siloed to suppress the gold price. The Chinese market is siloed to the exact opposite. Now, this highly leveraged, non-deliverable US-centric COMEX price is currently setting the Western gold price, but in fact, there is no physical to deliver. And due to the massive leverage employed, these paper warrants that underpin the tiny volume of physical are only able to be delivered in the form of a cash settlement. Now, while we evidence an apparent continuation of the 50-year gold suppression game, the cartel is increasingly constrained to a tighter and tighter physically supported paper gold range. They dare not uncover competing central bank delivery obligations that cannot be offset in the paper markets. That a perfect example we evidenced into the most recent official interventions, and that happened last Thursday. You can look at any chart you want, look at what happened. And despite having generated massive momentum-driven naked short sales, i.e. muscle memory. Get these guys, just tell them they're chasing a dot on the screen. These are not the sticky guys. These are the guys that have got a dot on the screen. It could be 2,000. It could be zero. They don't have any clue this has anything to do with any physical wholesale market. So, but the Fed does. And they had to ensure that they front ran the central bank sovereign physical bids that were waiting to be filled. And we talked about this level, that they would dare not go below. And this was the deliverable spot market at 1900s, spot, that is. And it's trading at roughly, 20 something dollar discount to the futures market, the December futures contract. Now, look, a really quick note for you traders. And I think, again, 2 seconds for this. In the wholesale markets, what we saw, this is so important, the footprints were so clear. Officials, this proves it, officials heavily intervened in gold, but with very few non-sticky longs left to rinse, they were unable to garner enough spec short bandwidth to be able to cover the paper side of this COMEX dip below the deliverable central bank sovereign bids identified as lurking at 1900 or below 1900 spot, which is about 1920.50 in futures. And on the other side of this paper market structure, it looks too risky for the commercials, the officials exposed to physical delivery, to chase gold below these central bank bids at the spot round number. This should help to support related silver too. But bottom line, the lines cross between how much siloed COMEX open interest can be covered into before officials and their agents are exposed to a simple backdoor physical mechanism called, we've talked about it before, the exchange for physical. The cartel's Achilles heel, the conduit which enables a paper COMEX warrant to actually be transferred into a spot deliverable contract.
Hey, Andrew, by the way, what a great interview you did last week with Jeff Snyder. It was amazing. This, I guess, since this episode aired, we've had a lot of questions, and the community's asking you, what you think about the Fed's ability to micromanage the terrible mess that they're in right now. So what are your thoughts on this?
Yeah, Shane, and Jeff provided some great insights into the euro-dollar market, which so few people understand. And it also brought to mind that it's been 15 years since the Lehman collapse and the bank that triggered the global financial crisis, their sudden bankruptcy triggering the daisy chain of events that led to severe global repercussions. Now, my discussion with Jeff last week about digital currencies really raised some interesting topics. Namely, that decentralized blockchain technology, a trustless accounting medium, is already out of the bag, and its frictionless utility ultimately challenges the status quo, threatening to make banks redundant. Now, obviously, once automated KYC, AML procedures are verified, why would we pay a bank a friction fee to process our transactions? I mean, blockchain technology is an existential threat to the banking system. And with this in mind, it looks like the Fed is pushing on a string. But in the very short term, this out of control Fed has to be very, very careful. If they raise rates, even if they try and emulate Lagarde and hike, then pause, they risk triggering the forewarned Fitch first tier, too big to fail bank downgrade. And while we expect the obligatory algo-driven volatility into every Fed event, either way, hike or pause, with gold so close to central bank bids and major concerns of a banking crisis being triggered, liquidity providers anticipate a forced physical related rally to ensue. So feedback from our meetings with the liquidity providers following last week's heavily gained price suppression even though spot gold central bank bids were front run, they still confirm the largest central bank delivery and fulfillment since March, when gold was trading at $1,818. More layers of short stops will be uncovered. These are bets against gold. Once you start getting above them, you need to jump out of that trade. And they'll be uncovered once known central bank sovereign buy stops are triggered around gold futures, 1968, thereabouts. And as far as silver is concerned, as we identified in our last market update, every dip below $23 spot, that's 23.27 in futures, has been aggressively jumped on by Indian Asian buyers and was unable to stick. It is Indian demand that is forcing insiders to ring the register on naked short specs way earlier than they'd like to. And whichever way you look at the short, medium, or long-term picture, every single gram, ounce, kilo, and ton of gold and silver is grossly underpriced. And under the smoke and mirrors swan song, paper market action, just one question, guys. How much physical do you own?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our Live from the Vault community, buy physical and make sure it's backed 1-to-1, and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. And please help keep spreading the word about this channel by hitting that like button if you haven't already done so. Share this and also subscribe. And if you click on that bell, you'll be notified each time an episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.